Hello everyone, welcome back to another FinMeUp weekly wrap where we cover the most important JSE as well as Nasdaq companies and their announcements, directors' dealings, results, all of that. Welcome back. Today is actually Paul's 1 year anniversary at FinMeUp. He's been a lot of things. He's been the quiz master, so if you've been playing the quiz, if you've been reading the FinMeUp content, if you've been reading his content, if you've been watching these videos, and also he is a financial advisor. So if you want to book a call with Paul, it's free. The link is in the description. You can book a 30-minute call with him. So let's get into the news for this week, and congratulations, Paul. So first of all,
Thank you.
Trueworths. Sale of merchandise grew by 13.1%. Retail sales grew by 13.7%. Profit before finance costs and tax grew by 5.6%. Earnings per share grew by 12.5%. And they declared a gross dividend, interim dividend of R3.20. What do you think of these results? I don't really follow Trueworths. It's just another retailer. As we've mentioned quite a few times on this channel, that my favorite retailer is Shoprite, and I know yours is Pepkor if I'm not mistaken. But do you follow Trueworths at all? If so, what's your opinion?
Yeah, that's exactly one of the points I want to make, Higgo, is it's just another retailer. I'm not sure about the Trueworths brand. Like, have you ever really shopped there? Do you know exactly what they stand for? Let's just chat about the results first. So the results, sales grew 30.1%. Profit before finance costs and tax grew by 5.6%. Not great, Higgo. And as we've discussed, inflation, interest rates, load shedding. None of these factors are helping the retailers at all. And now let's chat about the brand. So Trueworths, if you think about it, in terms of price and quality, they're somewhere in the middle of the pack. They're not for the upper class, like a brand, as a brand like, let's say, Woolworths, and they're not for the middle to lower class, one of those popular heated home brands like Pep, AC Kermans, or Mr. Price. So I'm not really sure what exactly their target market is. And even though the multiples look good, they've got a low PE, high dividend yield, the share price has really underperformed the last 5 years. They're down 46% for the last 5 years, and the market just isn't excited about this company, and neither am I. So maybe there is a narrative here where you can say, yes, this company is actually massively undervalued, or why aren't they performing? But this is not a company where I personally shop, and it's not a company that I'm personally excited about.
Spur. Oh, that brings back childhood memories. Every Friday, get there, eat your ribs. And they're still going. They have so many brands under their name, including the likes of Rocco Mamas, for those who like burgers. But let's get to their results. So their restaurant turnover grew by 31.5%. So that's for the franchised restaurant section. And then the total revenue grew by 35%. Profit before income tax grew by 103%. And earnings per share grew by 198%. So that is huge. Huge growth, but also remember, coming from lower bases, when people weren't eating out a year ago, 2 years ago, as we had lockdowns and all of that. But these results look good when you look at it at first glance. I didn't expect Spur to perform this well, but seems like there's still a massive appetite for their steaks, their burgers, and their wraps. What do you think, Paul?
Yeah, you go like Spur is one of those franchises where I'm gonna take my family to one day. It's just it's the nostalgic value. You can't put a price on that, and they have good food. So remember the results. It looks good, but it's post-COVID. So 2021, we were still like, at least for the first half of the year, it was still pretty much COVID times. So if you compare it to that, 30% is good, but it's not like amazing, but very good. And it's quite impressive given that it's a franchise where you kind of dine out. It's not really your McDonald's or your, I don't know, KFC where you typically see people Uber Eats. This is a place where you actually go to with your family, and it's quite dependent on household disposable income. And given a recession, that we don't have a lot of disposable income. So the fact that the result is still positive gives me hope for the share price. And yeah, this is not something where there's not a company where I kind of invest in. I go and dine there. But for those people who are, the share price hasn't been performing too badly, and the results are good. So let's see what happens.
The next one, Woolworths, another loved retailer by many. Their food prices have definitely been increasing. I can testify of that. Their turnover and concession sales increased by 18.5%. Just note there, what impact does inflation have on that turnover? We've been seeing with all of the retailers, a lot of revenue growth, but how much of that is actually from inflation? Profit before tax grew by 63.3%. Well, there could be an answer because the profits look really healthy. Earnings per share grew by 74.9%. Free cash flow per share, which is a vital metric to look at, increased by 29.3%. The company also repurchased shares worth 1.5 billion rand, and as you know, I'm a big fan of companies that do share buybacks at the right time. I know in Warren Buffett's letter this year to his shareholders was also highlighting the importance of share buybacks once again. And then there's not a lot of negatives. Just quickly on share buybacks, when companies do that, it's a way to return money to shareholders. It increases the book value per share. It increases your holding in the company. Why some people don't like it is some people prefer dividends for that passive income, and some people prefer companies rather investing into the growth back into the company. I'm a big fan of share buybacks when the company is underpriced. Anyway, just a quick note on that. The company has also entered into agreement to sell its entire shareholding in its Australian subsidiary called David Jones to transform its balance sheet and reallocate capital to its core businesses. And as we know, David Jones has been a pain in the underground for them. The company said that load shedding has reduced South African adjusted operating profit by 15 million rand per month. So another big retailer really feeling the effects of load shedding. And the board declared an interim dividend of R1.58, and that will be paid on the 20th of March. So just check the last day to trade and all of that if you are a dividend person. What do you think of these results, Paul? I know you're a massive Woolworths fan. Usually when we're at office, Paul's favorite time of the day is to go into Woolies, even if it's just to get their sanitizer. So what do you think of these results?
No, I'm definitely drinking from the Woolies Kool-Aid. I love Woolies. So for the listeners and the viewers, so Woolies consists of Woolies food, which we all, or some of us love more than others, looking at myself. Then you've got the fashion, beauty, and home side of the business, David Jones and Country Road. Now the Woolies and David Jones segments have been performing quite well, but the David Jones segment, like you said, Higgo, has been a real pain and a massive destruction of value for the company. And finally now they've sold it off. So for me, the big narrative here at play is how will they reallocate that capital into the businesses that are actually making money, and how will that actually affect, the top line and bottom line growth as well as the share price growth. So I'm quite excited about this company, given the new capital that they now have. It's all about capital allocation for me. And then, like you said, Higgo, just the rest of the results, we've said it 100 times before. You've got load shedding, you've got inflation, but they've paid out a nice dividend. So let's see where this actually goes. I'm inclined to dip my toes into the stock. Love the product. I think the share price will do quite well.
Interesting. MTN Group earnings per share is expected to increase between 35 and 45%. They are really rolling out good results. Data and airtime is a currency of Africa. It's what we need to even communicate like this. And it's just on the ever increasing, but on the other side, there's a lot of pressure that the data prices and airtime prices must come down. So MTN, great company. It's a complex company. It's such a big company, but they are still growing. I'm sure shareholders are happy with these results. But do you have any take on this?
Yeah, Higgo, I have a lot to say about MTN. I think we should wait for the full result statement to be released. But just looking at this, between 35 and 45% earnings per share increase is very, very good. And especially given that most of their operations is in Nigeria, that's always a little bit like, oof, I'm always scared because Nigeria is very politically and economically a little bit unstable, even though they're one of the biggest economies in Africa. But let's wait for the full set of results, and then we'll discuss in detail.
Aspen, not a company we usually cover, revenue decreased by 1%, normalized EBITDA decreased by 11%, and earnings per share decreased by 18%. Just taking a quick stance at the overview of those results. The share price rocketed. Why might that be?
You asking me, Higgo, you know what I'm going to say. It's always the same. It's always reality versus expectation. The results don't look that good. I mean, let's be honest, revenue decreased by 1%, EBITDA down by 11%. And then based on the results, the share price went up 20% in a day. How does that actually happen? And like we said before on this channel, guys, the listeners and the viewers, it's expectation versus reality. So the market expected it to be worse. And when the results were now released, it's not that bad. Boom, share price skyrocketed by 20%. So this is, let's just touch on some other stocks. This is the reason why I'm always cautious to invest in stocks like, even though I love the stocks, Purple Group, Renergen, Tesla. It's because everyone is so excited about these companies. And when they don't get the lights out, then the share price, dumps, potentially can dump by quite a bit. So Aspen is the biggest pharmaceutical company in Africa. I've covered it on the app. I love Aspen. It's a great company. It's made me money in the past. For now, I think personally I've made my money. It is a share that I can invest in via top 40 or one of those stables in my portfolio. But it's not necessarily a stock that will go 3x within the next 5 years.
Curro Holdings, an education play. So revenue increased by 17.3%, EBITDA grew by 17.4%, earnings per share decreased by 7.4%, and the board declared a final gross dividend of 11 cents per share. And they're also going to reinvest once again a lot of capital into expanding their business and into the infrastructure and all of that. Curro is a company that sometimes you love them, sometimes you don't like them that much, especially as shareholders. In the beginning, the first few years of Curro, the share price just went linearly up, and then it came back down, almost linearly down. And there's quite a few things that people don't like. There's a few things that people do like. Personally, my favorite educational play is Stadio, and just quite interesting. Quickly touching on Stadio, I think the result is going to be quite interesting. I know this is a weird metric to look at it, and it's a bit, not in the textbooks, but usually when it comes to B2C companies, the Stadio is B2C, the consumers is business to consumer. The consumers are the people that get educated, the students. And with B2C companies, I usually go to Google Trends and I search the company. Now, if you go search Stadio, there's a massive increase in website traffic. Whether website traffic directly leads to more students, I don't know. Nobody knows. But one thing is for sure, Stadio is getting a lot of traction, and while I like Stadio much more, it's more online play, less capital intensive. Curro needs so much money, schools need so much money continuously, the infrastructure, impairments, new schools, continuously, it's just too much for me. That's why I prefer Stadio. Paul, what's your take on these results from Curro?
Yeah, Curro, like we've also discussed on the app before, you've got Curro, you've got Advitech, and you've got Stadio. Those three are the main educational players in South Africa. And for the last 5 years, Curro has not been doing well at all. Like you said, the early days were the golden days. And, Curro as a company, just a 30-second summary for the viewers, founded by Dr. Crispin and Merwe. You realize there's massive untapped potential in the private schooling sector in South Africa. And then what happened was they built, and built. Massive potential, but the question was, could they fill up the schools fast enough? And they couldn't. So that was massive, capital expenditures, and they weren't getting their money back fast enough. Finally, the schools started to fill, but then you had, let's say, a lot of hurdles along the way. COVID was one of them. So massive debt book, bad debts, students couldn't repay, or the parents couldn't repay the school fees. Then you had the PSG unbundling, which led to a massive dump on the market of Curro shares that were already struggling, and a massive sell-off. So I don't want to say this out loud because I also own Curro at a stage. The share price is down 73% over the last 5 years. That's very tough as a shareholder. But, and this is a big but, despite all the bad news, I do potentially see personally, I see a recovery narrative playing out here, because I think all of the bad stuff has now kind of hit the market, and it may be time for us to recover. What I mean by this, I mean they've built a lot, they're still building, but the capital expenditures in the expansion is not as much as it used to be. The schools are filling up. COVID is over. They're recovering some of the bad debts. The PSG unbundling has now happened. They have dumped the shares, and the market has internalized that. So I'm inclined. I'm definitely looking at this stock as a potential opportunity. Go.
I know Curro is one of Anthony Clark's, who's also a mentor on the FinMeUp app, so you can check that out. All of his articles. He recently posted an article, his top 3 high conviction stocks, and a lot of other research. But we did an interview with Anthony Clark about his top picks for this year. The link is in the description to that video. But he spoke about Curro. Curro is one of his picks for the year. So, if you want to know why, just go check that video. It is free to watch. Getting to the last company, and before we get into this last company, remember you can book a free call with Paul. The link is in the description, and you can ask him your financial questions. He'll be happy to help. The last company is Grindrod. Revenue grew by 58%. EBITDA grew by 32%. Cash generated from operations grew 62%. And the board has declared a final gross dividend of 22 cents per share. That dividend is quite small, but remember they paid a big dividend in December but that was not an ordinary dividend because they sold Grindrod Bank. But this dividend for normal operations, it is tiny, but they are paying a dividend. If you look at the valuation, the PE ratio isn't too high. The recovery story remains intact. They're doubling down on resources, so as long as there's a demand for resources, which there will most probably always be, Grindrod will do well. Grindrod is definitely on my radar. I'm quite interested in this. It's a company that I can't see how they won't be in 10 years' time. Logistics is so important. That's why I love Santova. Currently, my favorite logistics company is Santova. It's just, I've covered it many times on the app as well, so you'll know why there. But, solid results from Grindrod. What do you think, Paul?
Yeah, you go. I didn't know you were a Santova fan, eh? Nudge, nudge. No, Grindrod, this company did very, very well. The share price is up 70% over the last year. They're very well positioned to take in industries that are kind of anti-Transnet, which, there's a lot of them. And I think there's definitely more potential for this company. I did invest in this company. I did sell my shares because I felt like we've had a very solid run now, but I think, there's definitely more room for expansion for this company. Also, to have Santova and Grindrod both in logistics, I don't want to overweight my portfolio, but Grindrod is definitely, if you bought this stock, you're a very, very happy shareholder, and I'm glad that the company is doing well.
Yeah, I mean, you didn't only receive capital growth, you also received the juicy dividend in December, so quite jealous of that. Thanks for watching. I hope you have a great day. There were a lot of quality posts on the FinMeUp app this week. Remember to play the quiz, check the links in the description, and hope you have a great weekend. Cheers.